Before we were talking about SpaceX, I was talking about this chart that really showed market swaps, market expectations on either a pivot or a forced pivot by the Fed as a result of a policy mistake. So is that the sort of thing that you think at least equity investors are thinking about at the moment?
Yeah, as you know, the hawkish comments coming out over the last couple of days, which you guys have talked about, has really forced the market to expect the Fed to continue to hike very aggressively, and maybe a policy mistake that could choke the economy, and therefore the market might be expecting some sort of cuts somewhere down the road. I don't agree with that. I think that the Fed will continue to be very aggressive, but they might start to fine tune along the way. But as most of the Fed officials have said, they are very data dependent. So we need the next few data points on CPI and related data would be extremely important in formalizing their strategies over the next few hikes. And then react afterwards. So it's extremely difficult to interpolate, towards the next 6 to 12 months in terms of rate policies. So that is why we're sort of holding a little bit of cash for now and wait for better opportunities.
Yeah, so holding more cash, really avoiding long duration at this point. What's going to be the catalyst for you to get a little bit more bold?
Indeed, I mean, markets, don't wait for the signal to pivot, before rising. So they precurse expectations. So if there is any signs of supply constraints being further mitigated, and the related issues coming out from the pandemic, then the certain core inflation dynamics may start to soften. But still, again, given the commitment of the Fed, we're unlikely to see them pivot anytime soon. But if it happens, I would think the potential would be pretty significant, because of the peak bearishness that the market holds on almost every asset class in the world.
James, this chart on the Bloomberg showing how global stocks are already pricing in that drop in earnings forecast. We're headed, of course, towards those results. What are you expecting, and how will the markets react?
Yeah, the looks of it for now is that earnings expectation for, say, U.S. corporation is quite mixed, because by definition, higher borrowing costs, slowing demand or demand destruction, coupled together with continued high costs, whether production costs or labor costs, should really squeeze margins. But as we see, long-term track records, U.S. companies are pretty quick and flexible in adjusting the production or capital structure to adapt to the different phases of the business cycle. So my expectation is, yes, earnings may weaken, but I don't see yet, the risk of a full-blown earnings recession.
James Leung.
To the other part of the world, sorry.
Go ahead.
China.
Mm-hmm.
So, the other part of the world in China, as I spoke to our Chinese equity specialists just yesterday, they're looking at earnings revisions very closely, and having had really negative revisions over the last couple of quarters, they are seeing revisions at least starting to stabilize and turning slightly ever positive, so that it might be a different picture in China.